Sorry, my bookshelves look a little empty behind me, but we're moving actually to the East Coast to North Carolina shortly for family reasons. So we've started to pack already. So I think it'll look all right, though, won't it?
Yeah, that's fine. That's fine.
Good, good.
Oh,
good.
you're permanently moving to the East Coast now?
Yeah, we're going to Chapel Hill, North Carolina. So we're leaving in about 4 weeks. So from around the end of September, I'll be on East Coast time, so it'll be a little different in terms of your time for me. But
Correct.
yeah.
Good to hear. But how is the situation on ground? Are there more restrictions?
Well, CDC has come out and said that they're recommending mask wearing again, whether you're vaccinated or not, inside, in closed spaces. And I don't think that's either surprising nor is it difficult. And I've been doing that anyway for a while because I wanted to be cautious because of the Delta variant. The problem, as you probably know, is that they have this thing over here called states' rights. In other words, they have a situation where individual states can decide what they want to do. So the CDC advice can be ignored or not. And so inevitably, those areas of the country which are fairly liberal, fairly left-wing, fairly Democrat are imposing some of this, including in parts of California, whereas other parts where there aren't many vaccinated people anyway, which are more Republican and more conservative, they're probably not doing that. So it's still a bit of a mess. But my feeling is the rise in these cases will peak before too long, and then they'll start to go down again. But there's no doubt right now the data on the Delta variant, not on the deaths, but on the number of cases, is quite serious.
Mm-hmm. Yeah, I think everywhere it's the same situation as well. I mean,
yeah,
no one's really able to understand what's the next step from here on as well.
Yeah, that's right. And but anyway, so well, what do? We start in
yeah, we
3
start
minutes.
right. No, we can start right away.
Yeah, okay. So this is pre-recorded, and
yes.
When will it go out?
It'll go out on all the social media channels on our digital channel.
Got it. Okay. Yeah. Okay. So right, I guess I'm ready.
Perfect. Just give me a second. Yeah. Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Geoffrey Dennis, independent emerging markets commentator, joining in. Geoffrey, welcome to the show, and always a pleasure to speak to you and get insights from you. Overall, let's quickly first take your thoughts with regards to what the FOMC has come out with in terms of, the commentary that did come out. What do you make of the entire commentary last night?
The general view seems to be that it was confusing. I'm not sure it really was confusing. I think what the FOMC said and what Chairman Powell said in his press conference is that the Fed is not yet ready to start tapering, nor is it ready to start thinking about interest rate rises. Now, so I think the market, as it tried to work through all the details of this, maybe try to work out if there was some confusion here. But at the end of the day, I think they're still on hold. They're still doing a lot of QE, $120 billion a month. And it doesn't appear as if they're quite ready yet to start pulling that back. Now, what I'm concerned about is that inflation is running pretty hot right now in the U.S., 5.4% year on year in June. And although it may very well be transitory, as the Fed is saying, it's becoming increasingly clear that some of that inflation pressure on consumer prices is beginning to spill over into wage pressures. And so my view continues to be that the Fed at zero interest rates and buying $120 billion of assets every month, both treasuries, of course, and mortgage bonds, is delivering a policy that is far too accommodating. which means if you combine that with the fiscal expansion that's going on, and there's a new infrastructure bill about to be agreed, apparently, and I think they're taking risks here. I'd like to see them moving a lot quicker. So the Fed seem to be signaling no change, but I think their strategy continues to be pretty high risk, frankly.
Right. So with all of this, how do you see the liquidity movement from developed markets to emerging markets, taking into consideration what the Fed is doing?
Well, emerging markets are having a terrible year now. I posted a note on LinkedIn this morning arguing that, well, not arguing, noting that EM had dropped into negative territory again. We're down on the year now, although that has got a lot to do with China, which I'm sure we'll talk about later. But aside from the China story, which has been very dominant in terms of emerging market performance, EM ex-China is up between 6.5% and 7%, which is not bad, but it's nothing like as good as the developed markets. And so you have to answer the question why, in the face of a pretty decent global recovery, aren't the emerging markets doing better, aside from the China issue? And I think the answer to that is that the dollar's been unexpectedly strong. The dollar's moved up pretty sharply this year against a number of EM currencies, particularly earlier in the year against the euro. And as I've always argued for many years, when that happens, money tends to pull out of risky assets, out of overseas markets, and come back to the US and really to seek safety. So how quickly the Fed moves here, I think will have an effect on emerging markets, primarily through what impact it has on 10-year yields and also what impact it has on the dollar. Now, if I can just say one more thing on this, and that is that, in my opinion, the dollar is overvalued. And so at some point, all of this expansion in the US, which is causing the current account to get bigger, substantially bigger, and the fiscal deficit to get dramatically bigger to levels we've never seen before, except possibly in wartime, does mean ultimately the dollar is going to go down, and that will pull money towards emerging markets. But while this debate about tapering and ultimately higher interest rates goes on, that's probably going to keep the dollar fairly well supported in the short run. So my view is the EM is going to struggle still a little bit more in the short term as we wait for the Fed to start tapering. But longer term, the dollar looks overpriced. It will come down. And at that point, these flows will start to move back into the emerging markets, in my view.
Right. But with all of this, how big a concern is the new COVID variant going to be for emerging markets? Do you think it could inflict a double blow in the coming months, taking into consideration that, around, say, 40% of the population in advanced economies have been fully vaccinated, compared to only 11% in emerging market economies, and a very tiny fraction in low-income developing countries? And this is as per what the IMF has said.
Yeah, absolutely. And I think there's a number of aspects to that question. Let me focus on two things. First of all, one reason to justify, if you like, why the Fed is sitting on its hands for a while longer is the Fed wants to see what impact the current rise in cases in the U.S., which it's been pretty substantial in recent weeks, is going to have on the U.S. recovery. Now, I happen to think it's probably not going to impact the U.S. recovery that much, and still policy is accommodating. But if the variant were to deliver much, much softer growth for a period of time, the dollar would probably fall. Money could move towards the emerging markets. So that's, I think, where you see the potential impact of the Delta variant on the U.S. But there is no doubt that the broader implications of the Delta variant around the world are quite negative for the emerging markets because, as you rightly say, the proportion of the population in EM and the developing countries generally that's been vaccinated is much lower. Now, the IMF, as you've also commented, made a very interesting set of forecast changes yesterday. They pretty much left their global growth forecast for 2021 and 2022 unchanged, But what they did is they raised their developed market forecast slightly, and they pulled down their emerging market forecast also, which therefore means to me that because of some potential constraints on easing fiscal policy in certain emerging market countries, Brazil would come to mind, Russia would come to mind, India indeed would come to mind on the budget front, but also because of the uneven availability of vaccines across many emerging markets, and indeed even more so than that across much poorer developing economies, such as in parts of Southeast Asia and above all in Africa, is going to hurt those economic recoveries. So I think you view COVID, the Delta variant, as being an excuse, if you like, for the Fed to wait a bit longer before they start to taper. But it is at the margin, it is a relative negative for EM growth compared to DM growth as we continue into this global recovery phase from this pandemic.
Right. So with all of this, let's talk about emerging markets as a whole. Taking the way emerging markets have been performing, you've mentioned in your note as well that there has been a sharp recent fall, especially in Chinese equities, that has actually pushed the MSCI emerging markets into the red for 2021. Where are you seeing, where there could be which market in the emerging markets is attractive according to you right now?
Well, let's deal with those two issues separately as well. I mean, the impact of the China story on EM is frankly very shocking. I mean, you've had such a crackdown on various aspects of the tech sector. You've got this battle with the US over Chinese companies listing in New York, whether they're going to be able to allow their companies to be audited in the way New York Stock Exchange companies are audited. Then you've had the impact of the shock moves following the Dadia, the Chinese Uber, if you like, listing a few weeks ago. And now you've got the dramatic move to effectively turn the education sector into a non-profit sector. Now, the question, as I posed in my post this morning, is where does this all end? Nobody knows. Maybe we're at the end, maybe we're not. But this is leading to a dramatic. Chinese shares before last night were down 18% in July alone, and this has been a really big hit for EM. Now, what would I do with China? I would begin to start adding a little bit of money back into China, perhaps not into these beaten down sectors yet, but into more of the cyclical sectors which are going to lead the recovery story, because the Chinese economy, notwithstanding this pressure on some of these sectors in the market, is going to recover quite well in 2021. But I would be focusing quite a lot of interest right now in some of the other cyclical plays, which of course are much smaller in the index now because of the growth of China. I think Brazil looks good, frankly. They've got over the worst of their COVID situation. They're benefiting from the global recovery. The central bank is raising rates to support the currency. I like Russia because I think oil prices are going higher. I think Mexico is a relatively good defensive play. I think Central Europe looks good. And I also think investors have got to look at India, even though, of course, as ever with India, the multiples are fairly high. And so there's obviously a valuation issue there. So I think what the China story is doing is probably forcing investors to, number one, focus a bit less on growth stocks and a bit more back on the cyclical, risky, if you like, economy opening sectors such as materials, such as energy, to a certain extent the banks as well. And I think it's forcing them also to really pare back their positions in China itself and take a look at some of the other markets. By the way, the other market I like a lot here, I like a great deal, even though it's done very well, is Taiwan, which is almost entirely due to the role that TSMC, the chip maker there, will continue to play in attempting to alleviate this global shortage of microchips.
Right. So, that's with regards to China as well as Taiwan. However, in terms of China as well, the anticipation is that on the back of the leash that has come in on the education sector right now, there could be a lot of funds that could be pulled out of China and come to other emerging market economies. Do you think India could then look attractive in terms of where Chinese FI money is concerned?
Absolutely. There always seems to be, for emerging market investors, there always seems to be a bit of a, do I prefer China to India sort of thing going on. And of course, there's a lot of other things that global investors could do, but there does seem to be that sort of debate, China versus India. And I think it's very intense right now because of this hit to the Chinese market. I mean, I don't think the Chinese market is going away. My back of the envelope calculation today, based on performances during July, is that the Chinese market is now down to slightly below 34% of the EM index. It was 40% at the beginning of the month, and at one point it was over 41%. So it's not going away. It's still big. It's just not as big as it was. Now, India is getting the benefit of some money coming out of China because of this sort of, the sense that investors look at the two of them together. I think also, as your listeners will know very well, you've got this surge of technology IPOs and new issues, which I think will attract investors because there is simply not the risk to, in my opinion, of this sort of regulatory risk anyway, this crackdown by the government risk to the tech sector in India that there is in China. So I think that will be a factor pulling money into the Indian market. Also, I think the central bank seems to be on the case of trying to ensure that inflation, although it's picked up sharply, does not run out of control at a time when the economy is beginning a recovery process. So I think there's a certain degree of confidence in the RBI. The fiscal side is always challenging in India, of course. And apart from valuations, the other thing you need to watch, and we all know this, I think, is the oil price, of course, in India, because if it were to move sharply higher from here, of course, India importing all of its oil would be hurt by that. But I see India definitely is a strong beneficiary of the problems in the Chinese market, not least because also the linkages between those two economies, China and India, are so small. There just is not a lot of trade between them. So to the extent that some of this regulatory crackdown in China could slow the economy, perhaps not give you as good a growth performance in 2021 as you might have anticipated previously, India is going to be largely unaffected by that. I think India's got to deal with its own domestic issues, which is keeping control of the COVID pandemic, ensuring inflation doesn't run out of control, and of course, trying to attract foreign investor money.
Right. So overall, right now, if you have to look at India as well, what sectors would you advise to park money in?
I certainly would like the tech sector in India. To be fair, I really liked the growth sectors around emerging markets, which worked, periodically quite well in the last 12 months. Of course, has not done well in the last month because of the problems of China. So therefore, you have to become more selective, I think, in terms of growth sectors across EM. You would look at technology, you would look at pharma. I think you would look at the banks because as interest rates start to rise, you'll see a steepening of the yield curve. And although obviously, as we all know, there are issues with asset quality across a number of the banks, I think the steepening yield curve should support the earnings story in India. And I think some of the more of the global cyclical names would probably do fairly well. I think one's got to be a bit cautious with some of the, the domestic, say the consumer names, and some of the other domestic cyclicals, because for that, you do need to know the economy is going to recover. So I'd probably pitch a portfolio pretty much like that.
Right. And very lastly, Geoffrey, with regards to where the money market goes, what's the sense that you have on emerging market currencies right now?
I think that the dollar is probably going to remain relatively well bid in the short term. I don't think it's going to go much higher, but I think on a 3 to 6 month view, it's probably going to stay relatively well bid as the markets anticipate the start of tapering. My view being, we know the tapering's coming. let's get on with it. If you were to see an announcement at Jackson Hole, at the Fed conference there, or at the FOMC in September or in November, you will not get a taper tantrum like you had in May 2013, because this has been anticipated. In fact, as I've written before, we know it's coming. Let's get on with this. So I don't see there being a big sell-off in emerging market currencies, a big rally in the dollar on the back of the Fed deciding to begin the process of withdrawing accommodation. You won't have any debate about the fragile five like you had in 2013. Now, within that, I think a stable but relatively well-bid dollar, maybe a little bit of upside, but not much. The countries that have done well recently are the countries that have actually started to raise interest rates, where their currencies have benefited and the markets have done relatively well. I'm thinking about Russia, I'm thinking about Brazil, I'm thinking about Mexico, not about Turkey, which is a whole separate story. Chile is another example of that. So where you've seen some currency weakness because of the dollar strength, where you've seen central banks moving interest rates, you've seen benefits to those markets because the currencies have rallied and the flows have come back in. So there is freedom of domestic monetary policy in a number of emerging markets to try to lean into what might be still a strong dollar. Longer term, on a 12 to 18 month view, I think the dollar goes lower. The deficits are enormous. The dollar will eventually go sharply lower, and then emerging market currencies will rally further. So I see the outlook for EM currencies being flat to selectively higher in the near term, dependent on who's tightening monetary policy, who's behaving properly on a monetary policy front. But I think the longer term outlook for emerging market currencies is quite good. For that, of course, you need a weaker dollar.
Absolutely, and that's something we will be watching out for as well. Thank you, Geoffrey, so much for joining us on the show. Pleasure speaking to you. Great insights. Have a safe move to the East Coast as well, and stay safe. Thank you.
Thank you very much. Bye-bye now.
Bye.